Hi guys, welcome back. This is gonna be the summary of the ICT Mentorship 2023 about conquering fear of being wrong versus profitability. As always, please refer to ICT original content. In this episode, we are gonna see beginners traders sharing intentions, being wrong and being profitable, a trade on the E-mini S&P 500, and SMT or relative strength analysis. If you are a beginner trader, ICT tells us to avoid talking about the fact that you want to be a trader with your friends or your family. He advises us to keep it for ourselves. Even your family sometimes and your closest friends would not understand really what you are going through, and they would give you funny or stupid comments that instead of uplifting you are actually bringing you down. In this industry, you're by yourself, and it's really about being profitable and removing distractions. It's better to keep it for yourself, become profitable and show yourself first that you can do it, instead of talking about it, being super excited about it and happy and wanting to share, and then having people ruin your great mindset before you get profitable for real. Happens very often that when you're about to place a trade, you start becoming fearful and you are in fear of being wrong. ICT tells us that you are gonna get it wrong once in a while for sure. Even himself gets it wrong sometimes. But what you need to keep in mind is that we can be wrong sometimes and still be very, very, very profitable, but you can also be right all the time and not be so profitable at all. That depends also on your risk management strategies, but also on how often you place trades. So you can be wrong and be very profitable trader. No matter if you're trading the ICT strategies or another strategy, you should find your model, find a strategy that works for you and stick with it. There is no need to let other people sway you or influence you, and no need to try, learn more or find new strategies if you have already found the one that works for you. Now guys, let's go on the E-mini S&P 500 futures for 1 hour, 50 minutes and 1 minute time frame, as you can see them here in this chart. You can always find the time frames on top of the chart, so as you can see here on the top left the 1 hour, bottom left 15 minutes, and on the bigger chart the 1 minute. ICT tells us again that he uses this secret indicator, which we can see here on the bottom. That's actually the price on the Nasdaq. You can actually learn how to add the Nasdaq or the S&P, depending on what you're trading that day, as your comparison in my video on YouTube that talks about relative strength analysis and how to compare chart in TradingView like ICT. Now guys, let's observe the price movement. Here we have buy stops or buy side liquidity. And when buy side liquidity is activated and when the price crosses it, those orders become market orders and they really float the market with volume. Now let's compare the S&P and the Nasdaq, and to do so we will place a vertical line and check the highs and the lows before and after that line. So we placed here our vertical line and we can see that between the S&P on top and the Nasdaq on the bottom we have two lows and they kind of match. Now we keep moving in the line and we arrive at this point. What we see here is that the lows on the S&P and the lows, the two lows in red on the Nasdaq, actually do not match. So we have an SMT divergence. SMT stands for Smart Money Tools or Techniques. And an SMT divergence is used by traders to determine if the trend is getting stronger or weaker, which then may or may not lead in shifts in market structure and market sentiment in general. Now, what do we actually have here? First and foremost, we have here the SMT divergence, which we can see with the red circle. Then we have relative equal highs. We took away sell-side liquidity And that's also, to not be ignored at all, the right time of the day. Now, let's go back to our main chart with the 1 hour, 15 minutes and 1 minute time frame on the E-mini S&P 500. Let's look more closely to the 1 minute time frame and compare it to the Nasdaq. What we can see here with those lows that are going lower on the S&P and those lows that are actually instead going higher on the Nasdaq is an SMT divergence. And here we see it with even more details. As the S&P market is actually going lower and it is tapping into liquidity, the Nasdaq is actually forming lows, but it is not going to tap for liquidity. So you see here where the two big circles are an SMT divergence. And in my opinion, a very prominent one. Like here you really have no doubts on what's going on. Now guys, allow me to cover part of the chart just for a moment to tell you this. There is a difference between market structure shift and market structure break. The market structure shift is just a short-term change in market sentiment and it will deliver on a short-term basis. Instead, a market structure break is where the entire tie of the marketplace changes and we go on a change of trend. Market structure shift doesn't require a higher close above the short-term high. Instead, the market structure break does. Now, what do we have here? ICT tells us that this is a bullish breaker. He highlights the entirety of this candle from the top wick until the lower part of the body and it brings it in time. We can see here where the arrow is a market structure shift. This bearish candle takes out the fair value gap, but only with the wick, and it doesn't take out the low. Let's keep going in time and let's look at this. Guys, notice the precision. There is this fair value gap and the lower wick of this bearish candle touches the lower part of that fair value gap perfectly. That's the crazy part about trading with the ICT strategies and techniques. Like, you will see some things in the market that are so precise that it's undeniable. ICT tells us that we could have actually entered here on that wick and exited on top where the price actually formed that high. That would have been a good trade. Now, going back to our original chart with the three parts, the 1 hour, 15 minutes and 1 minute's time frame. Let's keep observing the price movements. The blue part that we can see highlighted on the 1 hour time frame, it's a fair value gap, and the same fair value gap is shown on the 15 minutes and the 1 minute's time frame, so it's always that area in blue. And I'm sure, guys, that you can notice the incredible precision with which the price taps back into it and then goes higher. ICT brings us back a moment and he shows us this fair value gap that you see here with the green square. He makes us notice that all the bodies of the candles are actually accumulating inside that fair value gap, and it's really interesting. The algorithm offers two possibilities to enter a bullish trade. So it's allowing actually smart money to accumulate inside that order block. And those are the two big circles that you see here in red. What's interesting is that these two dips of the price are actually coming back to revisit the fair value gap that we have seen before in green, on which the bodies of the candles were accumulating. ICT with this blew my mind. He told us that the two dips are going back to revisit the green fair value gap, right, that we have seen before. But what about that area that is there in the purple circle? Didn't that area actually rebalance the fair value gap? So the fair value gap should be a rebalanced area now, right? And not be anymore like susceptible to these type of dips. Well, ICT actually tells us that those candles that are in the purple circle are not rebalancing that fair value gap. because they are going and hunting for the fair value gap that you see with the blue line on the bottom of the chart. And those candles, the bodies of those candles are going for it. And so they are actually not rebalancing yet that fair value gap. The PD array matrix teaches us that the price is, yes, we can look back at 20, 30, 60 days, but it also means that what happens today is projected forward by 20, 30 or 60 days. Pretty crazy, right? Now let's keep going and let's see what happens after. This bearish candle that you see here with the big black arrow is actually an order block. As soon as the following candle, the one showed in the green arrow, crosses the higher level of that bearish candle, that's an equivalent for us for a market shift. And the interesting thing is that as soon as that happens, the whole range of that price movement becomes sensitive to be revisited again. And for that reason, ICT highlights it in blue. Now guys, allow me to zoom in so that we can see it with more precision. We are here on the E-mini S&P 500 futures on the 1 minute time frame, and we have deeply zoomed in. So what we see here is displacement to the upside. The midpoint of that bearish candle is a level that we should be looking for because it is consequent encroachment level. So the midpoint is indeed our mean threshold. As soon as we sign it with the black dotted line, we can see that all of those candles are actually targeting and touching that midpoint. Now guys, let's keep looking at this price movement with an even bigger zoom. What can you observe here? Feel free to pause the chart if you need to and observe the price movements. We have here, as we have seen before, our mean threshold, and by the way, ICT to find that midpoint has actually used the Fibonacci retracement. What we want to see here is the price going lower and tapping into that midpoint while still somehow respecting it. So it's okay if it goes a little bit below it. It would not be okay for us, and it would be a warning sign if the price would really drop through it and just ignore it completely, which by the way is not what happens here. The price is indeed respecting it, somehow sensitive to the mean threshold. What ICT would have done is to actually be entering here where you see the first big black arrow, and he would have even increased his position there. Guys, between you and me, sometimes when I enter a trade, it would happen that I doubt myself if I enter here on the first arrow where ICT said it and the price starts going a little bit lower, and I really need to control myself to not exit when the price goes a little bit lower. And instead, you see, eventually we're going to get to the level in which when that happens, we're going to be so certain about ourselves, so certain about our trades that we're going to even increase our positions because we knew that the price will have to go higher. ICT tells us that he increased his position because this candle here that you can see with a big black arrow is actually a propulsion block. A propulsion block is the most sensitive area in order block theory, and it's an order block within the order block. So it's an order block on a nested level. So to be even more precise, in order block theory, when we have a propulsion block, the wick of that candle is the most sensitive area in it all. And so ICT highlights it and puts a blue area on it. And the crazy part is that the price then starts going higher, and we can see how precise that wick is. It's really incredible how clearly it is respecting that propulsion block. Now, I took away everything for a moment so that you can look at the price movements with a clear chart. And now let's keep going. We know that that high is our buy-side liquidity, and we see here also some relative equal highs. Now, looking at the area with the red circle, so after the buy side liquidity, after that first high, what is the highest closing price in that area? And the first one that we see is actually our rejection block on which we are going to put that red line. So the question that we should ask ourselves is, what is the highest closing price in that area? And the highest closing price is that bullish green candle on which we've put the red line at 4035.25. Now, what's the highest price in this area? And we know it's our buy side liquidity level. Now guys, remember what ICT was talking about in previous episodes, that wicks are gaps. And so ICT applies the Fibonacci to that wick, to the wick that shows us our buy side liquidity. And when we do so, we find the midpoint. And the midpoint is our consequent encroachment. Now, if we project it through time, what we see is an incredible precision and execution of the price, because the two candles top touches perfectly the consequent encroachment level. ICT shows us that we have actually a fair value gap there in blue. The big question is, how can we be sure that that fair value gap would stay open enough for the price to go higher? How do we know that that fair value gap is gonna stay open? Because of the propulsion block. So that is actually a getaway or a breakaway fair value gap, and we would expect it to stay open. So considering that that is a getaway fair value gap, ICT tells us that he would expect after that fair value gap a majority of bullish candles. And if we can look at that price movement, indeed we see only one bearish black candle, all the others are green. He expects a quick movement from that level, so from the fair value gap upwards, and he doesn't expect a return back if or better until the price didn't take away the liquidity. If the price takes away the liquidity, then it's normal that it could come back. Now, looking at the rest of that day, let's try forecasting the price movements and let's try understanding better what could happen after. As always, guys, refer to the time of the day, which is always very important for us. And if you feel the necessity, you can always check the PDF and go back and revisit the different screenshots shown here. When we try to forecast, we are trying to not pick highs and lows. We're just looking for where the liquidity would be, thinking about higher time frames and where the price could be attracted to, and of course at the time of the day. Last but not least, it's important to keep in mind where we thought the price could be closing on that specific day. So what do we know so far? We already took out sell-side liquidity. We are not sure if the price will run higher. We have to wait and see. If the price decides to not run higher, it is likely that then in the last hour of the trading for that day, the price could take out the low that has just formed around 12. As always, ICT compares and thinks not only at the S&P, but also at the Nasdaq and at the Dow Jones. And here we can see a screenshot of the Nasdaq for the 1 hour, 15 minutes and 5 minutes time frames. Instead here we can look at the Dow Jones. What do you observe, guys? Looking first at the Nasdaq and then at the Dow Jones. What is the price movement telling us? ICT looking at the Dow Jones on the 5 minutes time frame says that it looks a little bit like a heart attack. Now it's clear that the Dow and the Nasdaq are having a no trade day, so look at their price movements, it's very hectic. If the other indexes, so the Nasdaq and the Dow, that we know are highly connected, are having a no trade day, then we should also not be trading and just try another day. It could be that the afternoon gets also very, very hectic, and that we have a moment in which, if we would place a trade, the price would move so much and so hectically that we would for sure touch our stop loss. So it's not really worth it because it's a little bit unforecastable. So guys, remember, as we have seen before, the high of the week tends to form on Tuesdays, but that happens only 70% of the time. When it happens between 2 a.m. and 4 a.m. New York local time. That said, guys, keep in mind this information, but as everything else that ICT is teaching us, we have to use context, higher time frames, narrative bias. Just because on Tuesday morning at 2 or 4 a.m. we see a crazy high, that doesn't mean it's gonna be the highest high for the whole week. It's just like probable, but not sure, 1000%. So we really need to read and interpret the story that the price wants to tell us in its entirety. Anyhow, it's something cool to keep in mind. Guys, thank you so much for watching. Remember, this is the way. Keep going. Do not give up. Opportunities don't happen. You create them.